For many, it's literally a pipe dream. PIPE stands for private investment in public equity. Amid the SPAC boom, these have become highly sought after exclusive sidecar investments that help fund takeovers. Now, there are a few reasons for this. Number one, PIPE investors are privy to material details, including what the SPAC target is before the merger announcement. Number two, PIPE investors are often given restricted shares at a discount, either to the IPO price or the market price. In 2020, PIPEs generated more than $12 billion in supplemental capital to help fund 46 SPAC mergers, according to Morgan Stanley. But with all of that dry powder raised through SPACs last year, there could be more than $100 billion worth of PIPEs committed over the next 2 years.
The alpha generation that it represents obviously is attracting a broader group of investors, which has been really helpful, and I think will only benefit the product as we move through the balance of the year.
But if you're not one of the select few investing in PIPEs, there are a few things you should know. These deals can dilute your SPAC stake. There can also be pressure on the stock once the PIPE investors are able to sell, usually a few weeks after the deal closes. And PIPE investors may have information about the target that you don't have, Melissa.
All right, Leslie, stick around. We want to bring in Asim Grabowski-Sheikh. He's a partner at the law firm of Baker Hostetler for more on this. Asim, thanks so much for joining us.
Thank you for having me. I really appreciate it.
What is the issue here with PIPEs? They've existed for, I want to say, forever. But obviously, with the surge in SPACs, it's a more prominent area of finance.
Well, it's a great question, and there's a lot of reasons why these types of transactions make sense. PIPE investments provide strategics and other institutional investors more than just early mover advantage. It gives them better informed early mover advantage. And when compared to retail investors, there's tremendous information asymmetry. And the strategics, they have the upper hand. They enter into confidentiality agreements early in the process, and that gives them a peek behind the curtain before the transaction's announced. They perform diligence, and they have the benefit of time to structure and negotiate the terms of their investment. So at the end of the day, they know the company better, they understand the valuation better, and they've thought through the contours of their investment.
So, Leslie, is really the issue here for the retail investor who might be invested in a SPAC, who might be, it's almost like a double disadvantage in investing in a SPAC, because you might not have information about the SPAC itself, but then you might also not have the same information that a PIPE investor might have.
That's right. It's the information asymmetry that Asim mentioned earlier. There's also the risk of dilution with these things. There's dilution anyway that's oftentimes embedded into a SPAC with regard to the SPAC sponsor. Now you also could get dilution with the PIPE, especially once the owners of that PIPE are no longer restricted and are able to sell their stake, which it's important to note if you're an investor, that takes place just weeks after the merger closes. Usually with an IPO, you might be looking at a lockup as a potential event that could put pressure on your stock, but that won't take place usually for another 6 months. With these PIPEs, it could be between 4 and 6 weeks, kind of depending on how it's actually structured. So that's something to keep in mind if you are the owner of the SPAC and purchased it at the IPO or thereafter.
Awesome. I would imagine you're really busy these days. Can you give us an insight into what your pipeline is like, over the next 6 months, let's say?
Well, look, I think we all know that the SPAC market has had tremendous activity in 2020. It was a banner year, and we can expect a lot of M&A activity to flow from that. I think it's only natural. But you were speaking earlier about the risks to the retail investors, and I just want to point out there's risks and there's rewards. And yes, the risks relate to potential dilution, and historically that's always been the case.
Shepard Smith here. Thanks for watching CNBC on YouTube.